Yeah, no, I am completely, happy for them that they've made
just quality is going to go down the tube,
ton
right?
of money, right? But now it'll become, Starbucks quality coffee, which isn't great. So, now we need to go find a new little off-brand somewhere to start
helping them up and come, and yeah,
so they can be the next people to sell out in the market, right?
Perfect.
So if you've got an up and coming brand of coffee, let us know, and send us a sample. We'll try it out. If we like it, we'll start promoting it.
We'll promote you to all three people, and
exactly, we'll share it internally. Anyway, a couple of things here, as I said. So as I was talking about a second ago, look, the Fed was very adamant yesterday that they are adhering to this idea of hiking rates and winding up the balance sheet. We're now talking about 4 rate hikes this year. Now remember, early last year it was 2, then it was 3, now it's 4. So this rate hiking campaign is becoming much more aggressive, and the balance sheet reduction is becoming much more aggressive. So the point about that is that's going to create a change to the market environment. As the commercial said a second ago, and as Danny's got coming up very shortly on Candid Coffee, 2022 is not going to be 2021. They're going to be very different years, and a much more challenging year, I suspect. But this is also, a function of a change in liquidity, pandemic-driven benefits, and, a lot of the things that occurred during the pandemic. And as I was saying earlier, all that liquidity went into an economy that created spending, and it pulled forward demand. So in other words, I gave you a check for $1,400. You didn't save it. You went out and you spent it. What did you buy? Well, you couldn't travel. You couldn't really go out and eat, so you started doing home repairs. I mean, we saw Home Depot and Lowe's. It's so funny, right? During the pandemic, we're all supposed to be locked down. You go to Home Depot, they're crammed with people buying stuff, right? They were the super spreader centers of COVID during the pandemic. But this is because we gave people all this money, and so they were pulling forward demand. Now, what are they going to spend? And in fact, Danny, there was a recent study on pandemic spending as well.
There was. So it's interesting. So John Hancock does a study every year on annual stress, finances, and well-being report. Right. And so just what you would think, there's been a little bit of additional stress caused by the pandemic, but surprisingly, there's actually been some areas where people feel a little bit better. There hasn't been as much decision fatigue, is what they call it, because people didn't have to make as many decisions based on spending.
Right.
Hey, where are we going to go out to eat? Where are we going to go? Oh, wait, everything's shut down. We can't go anywhere. So believe it or not, that actually was a benefit for many households. Now, coming out of that, we'll see how people respond as far as what spending habits
I think
look like.
The big decision, in the households was really, which alcohol to drink. I mean, that was more of I think that was the big, and then you wind up not being able to get your favorite alcohol because of the supply chain disruption. So it really became a challenge to get alcohol.
Yeah, alcohol investors should feel pretty good because typically, they call them recession-proof. Now we can say they're also pandemic-proof.
They are.
So,
and people are converting vodka into hand sanitizer. So there you go.
Wow, I didn't hear about that one.
Really?
That's impressive. Hey, all kinds of uses, guys. Next time you go to the liquor stores, hey, babe, sanitizer.
Exactly.
All good. So, lots of different things that are going on, obviously. But the study did find a handful of things that were not too shocking. It said 58% of respondents responded with financial stress. 87% of those said that their finances were a cause of that. Imagine that.
Yeah.
And so some of the bigger things is that some of the things that I think that we're seeing now is that many people have said that they will not work for a company. And we're seeing this big shift that many people are wanting more benefits,
right?
More retirement benefits, more help, more guidance, financial advice surrounding that. And so I think that this has actually been good in that aspect, that made people are a little bit more aware of some of the things that are out there and then what they shouldn't be doing. So this has been a big push for us as well. As we always try to help clients navigate the retirement space. We've actually, just a little bit over a year ago, hired a retirement plan consultant, Tom Allen. You guys have probably visited with him or heard him on the show a couple of times. And this is something that is really important because now employers are really having to think about how do you retain top talent, especially when we look at, labor force participation rates, employment numbers, people, and then every day you hear new studies that people are leaving jobs to start their own business or do something different. So,
and that's an interesting, and remind me about that in a few minutes because every year the Census Bureau comes out with the number of people that are creating new businesses, and that doesn't really jive.
Yeah, see, I don't quite get that either because we see all these small businesses shutting down, yet all these other people are leaving to go create their own small business. I don't know if that environment's real ripe for this, right?
Right. Well, and again, the data doesn't support it. I just did a study on this just a couple of weeks ago talking about why small caps could be in trouble this year. And, when we talk about, and I know that we're deviating from your topic real quick, but, when you look at the number of businesses that actually have employees, that hasn't changed in like 20 years.
Yeah.
It's pretty flat. The number of small businesses have grown. The problem is the ones that are growing are the ones that have no employees. Now, why would I create a business with no employees? Well, those are LLCs, those are LPs, those are being used for family trust, estate planning, a lot of things like that for tax shelters, not for actually running a business. So, for instance, I have a family trust. It has no employees, but it's there to handle the family investments. So, there's a lot of those, and those grow every year. The number of businesses that by the time you strip out the number of businesses that go out of business, 80% of businesses fail. So if you think that you're creating, 50 new businesses a year, well, 80% of those are failing. So over time, they really don't change much. And the number of active businesses out there really haven't grown. So this also really goes into the employment numbers. When we get the employment numbers from the BLS, they have an adjustment every month. It's called the birth-death adjustment, which assumes that people ran out, as Danny just said. According to the surveys, everybody's quitting their job to go start a business. And so every month we add, 100, 200,000 people to the rolls on this idea that they went out and started a business and they're no longer counted in the actual employment, right? But they're there. They just created a small business. But the data of the number of businesses in the country doesn't support that either. In fact, the number of businesses have actually declined slightly over the last decade. So, which makes a lot of sense. We take a look at labor force participation rates haven't really grown, actually have fallen over the last decade. It makes a lot of sense because there's a 10 million person gap. If you strip out that BLS birth death adjustment, there's 10 million people missing from the employment report.
So where are they?
They're out there.
They retired early. They've done something different. They've taken a part-time job.
Yeah, they're no longer counted as part of the labor force.
But, going back to your point as far as new businesses being started, especially this last year with the tax code looking to change. I mean, there's a very aggressive push this last year for a change. So many people were, they were jockeying assets, trying to figure out where do they put things in the sense of trying to protect them.
Yep.
And so I would assume if we look back at 2021, we'll probably see even more created just because of that, looking at, limited partnerships, LLCs, things of that nature that do look like a business on the outside looking in, but at the end of the day, they're just there to shelter assets.
Right. And again, this this is also kind of one of the interesting things when you're talking about pandemic spending and people's financial situations. We see a very high quit rate right now. See people jumping around from job to job because they can get a higher wage. And to your point, right, they want more benefits. I think we're going to see a change to that. One of the things that, we're discovering is even as our business is that this work from home thing really doesn't work all that well. It's hard to be productive and maintain productivity, especially with the younger generation working at home. They need that supervision. They need to be in the office. And I think we're going to start to see a lot of companies go, that was a great idea for a while, but we have all this office space here. Yeah. So it's either going to be a two-pronged approach. Either major companies are going to start to liquidate their office space if they are going to move to this work-from-home environment. But I have a sneaky suspicion that we're going to see companies go, that wasn't such a great idea. We need people back in the office. We've already seen this with Goldman Sachs and a couple of other big financial firms saying, no, y'all need to come back to the office where you're more productive and you're more focused on your business and what you're doing. Just too many distractions at home. Too easy to go do other things and then come back to, do work. So, and again, you lose that work-life balance. All of a sudden, your work is your life at home. So I think, while the younger millennials go, oh, I like this work-from-home thing because I can have work-life balance, they're starting to realize already that work just starts to consume.
Blend into everything.
It just blends into everything, right? So, I think we could see a push for that to come back to the office. And the other side of this is that that's going to start. If you start demanding, right, well, I want to work from home. Okay, you can work from home, but we're going to pay you less. If you want to work in the office, we'll pay you more and give you more benefits. But if you're going to work at home, your rate is going to be lower. And I think and I think we could see that shift. And again, I'm just speculating here.
Yeah.
But in order to entice people to come back to the office, you incentivize people to come work at the office rather than work at home.
Yeah, and I think that's something that'll be interesting to see how that plays out, because you think about long-term leases, people that have been there for a while, companies that are still successful, yet finding, hey, we can be more efficient maybe if everybody's in one space. Yeah. I've had this conversation where we've done so many Zoom meetings, but it's really nice to get everybody in a room and have a discussion.
Yeah, there's something about collaborating and working, and when you're all working together and collaborating, and hey, just stopping by the water cooler and say, hey, Danny, I'm thinking about this. You can be much more productive that way than being so detached. And people are people getting zoomed out, right? I mean, they're getting tired of all these Zoom meetings constantly. So, we'll see. I think this year is going to be very interesting to how that work dynamic begins to change and how it begins to affect wages. Commercial property. I think we'll see some big changes this year. So anyway, be right back after the break. Asset allocation, is it for everybody? Is it one size fits all? Dalbar had a recent comment about that. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. realinvestmentadvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife had a craving for peanut butter and jelly while we were on our trip. And so if you bought peanut butter lately, it's freaking expensive. It's like $900 for a jar of peanut butter. Okay, not quite that much, but it was like $875. It was in the ballpark. She makes like one peanut butter sandwich out of the entire jar of peanut butter. And so I threw it in her suitcase just for fun on the way home.
The Real Investment Show podcast.
Watched her suitcase get searched at the airport.
At realinvestmentadvice.com.
She didn't speak to me for the whole way home.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, insight and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com with Ratliff and Rosso. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. I'm your host, Lance Roberts. Danny Ratliff joining you this morning. It's The Real Investment Show. Get by the website, realinvestmentadvice.com. Check out our latest blog posts that are there. Our daily market commentary is up for today. Make sure you subscribe for that. It comes out every morning at 7:30 sharp. Get you ready for the markets, what's going on for the day. Also, simplevisor.com is our new subscriber service. That's up and running as well. So it is all there for you every day. Subscribe to the newsletter. So much stuff. Keep you up to date on the markets and your money and what's going on. It's all at the website, realinvestmentadvice.com. So just wrapping up our conversation from last segment on this pandemic spending study. What were kind of the conclusions on that?
Well, so we were talking about the Stress Finances and Wellbeing Report from John Hancock, which they've been doing for the last 8 years. So have some pretty good information. And some of the things I think that were really, key and something that I honed in on was, and we kind of talked a bit about this, just this last segment, was cost of financial stress due to absenteeism and productivity loss rose considerably. Well, who would imagine that? Rose by 26%. But, some of the things that I think that are not shocking, but everybody says how the consumer is that much better off, and we keep hearing all these great reports that, everybody's doing better because of all the stimulus checks. Well, guess what? Most people went out and spent that money. So what they actually found was that 43% of respondents were behind schedule in retirement savings. 38% said they were on track, but 49% said that they were still slated to retire when originally planned, which we know more often than not that's not the case. Everybody thinks they're there and we're still going to do it. We'll figure it out. And then 24% did say they were going to retire later, which is a change from what they had previously said. So I think that some of the big things that we're seeing is that people want more access to information. They need better guidance. And there has been, we talked about the decision fatigue that people are experiencing. And it's so difficult with so much information out there. And so I think this is where a really good financial advisor could come into play. They're also saying that people, we think we're in this area where everybody's going to do it yourself. They're actually seeing an increase of people going and seeking good financial advice. So, which is why we're doing the Candid Coffees, Lance, why we're doing all these different things, real investment advice, like you mentioned. There's so much different financial information on there to help guide you, give you real information that's not designed to say, sell a product. It's really just to give you the information as a fiduciary to help you understand what's going on, how to protect assets, how to grow them. And I think that's what's really important. And so, keeping these things in mind, that Candid Coffee will be this Saturday. Go sign up, realinvestmentadvice.com. Go to the events tab. In fact, I think right when you pull up the page, you'll be able to log in right there. There'll be a pop-up that'll be there. So go check it out. It's an hour, 8 to 9 a.m. Central Standard Time. We'd love to have you guys there. Really informal setting. Rich and I just answer lots of different questions. Do have a couple things kind of pre-scripted, so to speak, that'll be ready for you. So, I had to get on Rich a little bit. I'm like, well, this isn't exactly as candid as usual, but we're certainly going to be answering your questions live. And if you have any now, please go to realinvestmentadvice.com, ask them. We'll be happy to answer during the show, or if not, we'll get to you afterwards. But, talking about all the things that are going on, Lance, and, kind of where we have been, from a market perspective, how people have responded economically, how they feel from their households, their well-being, and lots of reports out on asset allocation. So Dalbar did a new study, and they are suggesting that we now use a prudent asset allocation. So you're going to love this one. And Dalbar, I think, does a lot of really nice things.
They do some great research.
They do a lot of really good stuff. But one of the things that stood out to me was that this prudent asset allocation is essentially saying that you need to have, it's based on investors' cash needs for the next 5 years. Okay. But they're going to look at, if you're working, your income is going to be considered cash, what you're bringing in each year. So that'll be included in your cash bucket. Any cash you have, treasury bills, CDs, things of that nature.
Sure.
And the remainder, no caution to the wind.
Yep.
All stocks.
Risk assets.
And the reason they're saying this is that since 1940, the longest recovery period for any major downturn has been 5 years. But I could go back and anybody can pull up a simple chart of the S&P 500. No, that's not necessarily true.
Right.
Now, maybe we haven't had 5 consecutive years of a downturn, but just getting back to even
can take 12, 13, 14 years. A good example, just the most recent one, took from March of 2000 until June of 2013 on a total return inflation adjusted basis.
Yep.
To get back to even. So, 5 years of cash isn't really going to help you that much. But I do see the point of this. And, that's something that, I do personally is I've got 5 years worth of cash set aside and very liquid assets and a lot of cash, just in case, one of my businesses or this business needs cash, or if something happens, there's, plenty of liquidity. I don't have to go into other assets and start forcing liquidations, which always occurs at the worst possible time,
Correct.
right? So what cash gives you is a bit of flexibility in terms of how to manage your risk in your risk asset pool. And one thing that you and I talk about a lot, and I think people really overlook this to a great degree, is particularly when you're moving into retirement or close to retirement or already in retirement, is your withdrawal rate during a decline. So, if the markets are down 10, and let's just, for grin's sake, say you're taking 5% out of your portfolio every year to live on. So you're not down just 15 in the year. So the market's down 10, you take out 5, you're not down 15. You're actually down like 18%. And the reason is because you're selling assets on the decline to take out that money, which is exacerbating the drawdown. And the compounding effect, we always hear about compounding, the power of compounding, most powerful force in the universe when it comes to finance. It's true. Works on the upside, great. Works on the downside, even worse, because you can compound losses just like you can compound gains. So, having cash then allows you to have a bucket that you can draw out of during market turmoil or market decline. So you're not having to, force sell good assets at distressed prices because you're going through a market correction.
Correct. And I think that the survey the study hits the nail on the head in the aspect that, look, you need cash.
Right.
We've been talking about emergency reserves. We've been talking about financial vulnerability cushion, going above and beyond. But I think that we need to be a little bit more, we need to go into detail a little bit more here, right? Because now they're saying, well, your income is going to count as cash.
What happens if your income goes away?
Correct.
Right.
That's exactly right. So now maybe in retirement, it's a little bit different because we have Social Security, you have a pension. We're hopefully going to be able to always rely on those things. And then we're going to have our bucket that we're going to have in cash. But this is why I think a good financial plan. So instead of saying, hey, go do a financial plan, they just said, keep 5 years of cash ready to go and you'll be okay.
And this is the beautiful thing about whole life insurance, right? That you overfund, you build up a cash cushion that you can withdraw tax-free at any time. And you get paid for 3, 4, 5% a year, depending on the policy, as an interest income.
Yep.
On the policy. So it's a dividend, and so that continues to accumulate. And even if you borrow the money out of the policy to get through a rough patch, it's still compounding the total value on the annual income. So it's a really great way to build this cash cushion that's
Correct.
actually growing for you and providing that safety net that you need. And this is one of the things like, oh, buy term, forget whole life, and it's too expensive. There's a lot of benefits that you give up not owning whole life insurance that you overfund on a regular basis.
Yeah, and that's a whole nother topic.
Another conversation.
We could spend days on that.
That's a Candid Coffee you and I should do.
Yeah, we should. And that's one of those things I think that goes. It's overlooked often. We hear about Dave Ramsey says, "Oh, never utilize something like that." But getting back to another avenue to have cash built up and have distributions that aren't going to be taxable later in life.
Yep.
Man, I mean, what a great tool. But this study, I think, is really what they're doing is they call the other asset allocation arbitrary asset allocation, where nobody cares. That you just say, "Hey, here's $1 million, put it to work, and we're just going to invest it."
Right.
And, I think we're moving past that as an industry.
Hopefully.
I would think, right, where it's a little bit more deliberate as far as how we're investing. We need to have that holistic approach where we're finding out what are your expenses? What other types of assets do you own? How do you own them? What's the registration? And people are getting smarter or more educated around this in the sense that they are starting to say, okay, maybe I should diversify where I am putting things. Maybe I shouldn't just put something in, everybody's buying things in their IRAs, their retirement accounts. And you can lose a lot of the benefits of owning some of these assets by doing so.
Yeah. Stop putting real estate in your IRA. It is the worst thing you can do. But, But this also brings up the point is that, one of the things I think the industry does really bad is they just make blanket recommendations. You need to be in this allocation mix, and you need to be diversified and own all these assets. And look, over the last decade, owning emerging markets international has been terrible. It's been a boat anchor on your performance. I think asset allocation needs to be very individualized. Everybody's different, and give up this idea of chasing benchmarks. Your benchmark is what you need to get to retirement on time, intact. Just because you can drive 100 miles an hour in a car to get to your destination doesn't mean you should. And, depending on your car, your skill, those type of things, there's consequences for stretching that risk profile in your portfolio, trying to get to your destination early. And more often than not, you wind up in a tragic accident that wipes out and pushes you out years to getting to retirement. We just see this repeatedly over and over again.
Well, and look, the odds are you're going to make your destination safely, but the one time you don't is going to derail you for a considerable amount of time. That's
exactly.
The issue.
That's right.
That's what's catastrophic that I think that is tough to put down on paper or just to think about. Oh, look, things have been great. We have the recency bias. Oh, it was a great year last year. We're going to have another year like this. I mean, how many comments do you hear like that?
Look, that's what the media says. Chart out this morning. In the year, this is a great chart, right? It says, after years where you have a 25% return in the markets, the average return the next year is 14%. Okay, first of all, that average is heavily skewed by the early 1930s coming out of the Depression, where the Dow was coming off a level of 80. So 80 to 160 is an easy move. Dow 30,000 to 32,000, different move, right? Big skews to that, but also kind of misses out the fact of 2000, 2008, those years coming after big returns that led to major downturns in markets. So, you got to be really careful with this. Yes, statistics say you should get an average, but average means you've been higher and lower to get to that average. And the question is, you don't want to be on the lower side of that at exactly the wrong time. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso, realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisor's free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show today. Get ready to wrap it up here with Danny Ratliff, of course. Hey, if I hear music, pod me up. Quit messing around over there.
It's one of those mornings.
Gotcha. just can't get employees anymore.
You've got your black rifle.
You don't have your.
I didn't get my black rifle this
What,
morning.
you wound up with a gummy bear?
Feel like it.
So anyway, getting ready to wrap up the show this morning. So kind of wrapping up this conversation about asset allocation. That also kind of brings up this whole problem with target date funds and 401k plans, and we've talked about the problem with those in the past, and now Vanguard's going to try to double down on that with new target date funds for millennials, right?
Correct. And this isn't necessarily news. They're always coming out each year or two because they're on a glide path, right? Typically on a 5-year schedule. Okay, 2020, 2025. Now we're looking at like 2060, 2065, 2070 as, people are aging up, so not really big news, but they are looking to become more aggressive, which I didn't think that was possible, considering like a retiree would be a 50-50 model. And this is the problem. We look at the new ones, the initial mixture of a 90-10, 90% stocks, 10% bonds, 54% U.S. stocks, 36% foreign stocks, 7% U.S. fixed income, and 3% foreign fixed income. So really not, they're just kind of blanket diversifying. The problem with this is, like you mentioned earlier, emerging markets, international, those have greatly underperformed. So these have been a drag on the overall portfolio, and they don't go and change it as quickly as what you would think. They're on a glide path. But they're just going to say, "Hey, hold it. You're going to be okay. You have a long time until you retire."
Yeah, and also too, it's there's another problem with these target date funds is that they don't actually have a target date. What I mean by that is that if I have a target, okay, let me ask you this question: why can I buy a 2010 target date fund today?
Well,
because it's still there, right? I mean,
correct.
I can still go buy that 2000. Why would I buy it? If it was supposed to be target date, it should theoretically mature in 2010 and go away, right? So if that's your target date, you're ready to retire. When you get to 2010, you're 100% bonds, by the way.
Whoa, no.
Oh, you're not?
No. You would think you were 100% bonds.
So it's not actually,
Yeah.
Okay, I
So
got you.
this is the problem with target date funds, that people get really comfortable and think, oh, well, we're on this glide path. It's going to get more conservative over the years. And Rich and I have talked about this on Financial Fitness Fridays, where we've compared multiple target date funds, and they're not all created equal. And this is one of the bigger issues with them, is that glide path may change at a much different period of time than what you expect. So you'd expect, if you're going to retirement or even go to their target date retirement income fund,
right?
What would you think that is? You think that'd be super conservative.
Yeah.
You'd have very little equity exposure.
Yeah,
But what
cash.
happens, it's all good until it's not. And what I mean by that is that when the market falls, man, you get usually surprised. It's a pretty big surprise when you say, holy smokes, I have 50% in equities.
Yep.
That's a big shock.
And that's
to
a
me.
retirement income, right?
Yeah.
I mean, and this is the problem with these target date funds. They're not really what they purport to be. And again, if I was building a target date fund for a client, just hypothetically, if you said, Lance, build me a target date fund, I want to retire in 2025 or whatever, then we would build it so that you had so much equity exposure now and some fixed income, but every year as you got closer, that allocation would be shifting more and more, so that when you got into retirement, it'd be 100% fixed income, and you'd have capital preservation ability there. And that's the other problem with these, is they're using bond funds, which have no maturity date.
Correct.
Now there's what's called a bullet fund. Those do exist, and bullet funds actually mature on their date. So at a certain date and time, a bullet fund matures and you get all your cash back, right?
Kind of like a UIT.
Kind of like UIT. So, you need to be, the point about this conversation is target date funds are not what they purport to be. They are not safe, and they generally underperform. So, and you can do a better job managing your own allocation than you'll do buying a static, kind of buy and hold type structure. It's a nice idea, and they're sold well because they're in 401. They mostly exist in 401k plans. That's where they've really kind of embedded themselves, and they seem like it's a good alternative. It's like, I just stick all my money in this target date fund and it'll adjust for me, and that's not really the case. And it certainly is not going to help you during a market downturn.
No, and that's the problem with many of these different asset allocations, that they just blanket invest. They stick. They're more static than they are flexible or active to some extent. And look, we're not suggesting you need to day trade or you need to be trading every week or every month. But I would expect, if I'm in some type of portfolio that gives you the illusion, and I say illusion because you would think that over time this would be something that does go towards the protection mode.
Right.
And so that's where the problem lies. And that, people, they're invested in these. They think, okay, because of my age, this is perfect. And now they feel bad about, once something falls, they say, oh my goodness. I mean, look at the lawsuits on target date funds.
Oh, yeah.
There's
Crazy.
tons of them.
Tons of them.
And so the
And
issue,
wait till the next correction.
yeah, that's right. Well, and that's the problem. So I think that, anybody in these funds needs to be, probably take a deep dive into it. Make sure you understand what you have. And more importantly, do a financial plan, because a plan is also going to show you your asset allocation. So that's a really good way for you to jump in. If you're doing research on your own, go look at the fund fact sheet. Go take a look under the hood and see how many stocks, how many bonds, and see where you're invested. Then go back, and I always enjoy this, but I'm kind of a geek when it comes to stuff. Looking at each year, how different are they? I mean, seriously,
yeah,
they're not as different as you would think.
No, and it's true. And so this just the point about this is just be really careful. One topic here I wanted to wrap up with before we get to the top, because again, we kind of talked about this earlier about self-directed IRAs.
Correct.
And, I'm getting a lot of emails right now. People worried about the market this year. They're worried about the Fed. They're like, hey, should I go put a bunch of gold in my IRA, physical gold, right? And you can do this. You can go, move your IRA to a trust company, and you can put physical assets in your IRA. Don't do it. It's a terrible idea. Putting physical gold in go buy physical gold. Go put it in your vault somewhere, right? Leave your IRA alone. Leave it liquid. Because the whole point of that is for it to grow and you have access to it when you need it. You don't need to put your gold inside an IRA. And plus, gold's not performing right now. So you're putting money into a dead asset. And it's not performing with inflation. It's not keeping up with inflation. So it's not helping you. It's actually hurting you at this point. Don't stick an asset that has an expense tied to it that is tax deductible in your IRA, because you lose the whole tax benefit. That's why you don't put real estate inside of your IRA. People go, oh yeah, but I get the capital appreciation. That's tax deferred. Yeah, that's true. It is tax deferred, but you lose all of the maintenance expenses, taxes, all the things all those tax deductions that you get, for a house. And plus, when you sell your house, the first $250,000 is tax free.
Correct. If you're married, you have $500,000 in capital gains that you're not going to have to pay.
So what are you doing? And so you lose all those expenses.
Well, that's if it's your primary residence.
Right,
Most people are doing it for rental property.
Exactly, they do. But you're losing but the whole purpose of running a rental property is you run it as a business. And so you have all the deductions to offset your income.
Correct.
And there you go.
Somebody paying down the equity of the home. And so I visit with a lot of different people and a lot of really smart people. And so I always enjoy asking somebody, especially when they're near retirement or retired, hey, what's one of the best things you think you did? Or what's something you would change about how you've invested or what you did? And I can tell you this, unequivocally, every person who's invested inside an IRA with real estate, every time they say, man, I wish I would have been better off just taking the funds out.
Yep.
And then buying them outside of this, because they forfeit all of those things you just mentioned, all those benefits you're not going to be able to utilize. And so that's something that is tough, because you hear all these different radio shows, you hear people constantly bombarding you with, hey, self-directed IRAs, here's how you do this.
You how to use your 401k to buy real estate. Yeah.
Well, and we're seeing that the IRS is cracking down on a lot of these things. So what they're looking at, they're calling them deemed distributions. Right. So there's actually just a case. It was U.S. Tax Court. So McNulty versus Commissioner, the IRS essentially, that they had a checkbook IRA. They were out there and they were writing checks. So essentially, you set up the LLC, you have the custodian who oversees it, and then you can write a check to go buy gold coins, real estate, whatever it may be. But all income must go back directly into that account. Well, they went out, they bought some American Eagle coins, put them in a safe at home. They were gaining, they appreciated over time. And guess what the IRS did? They came back and said, whoa, the custodian has no access to this. They're not overseeing this. You have physical possession of this, because the moment you take physical possession of
that is a distribution.
That's considered a distribution. Now, historically, they haven't gone after this, but now they are. And so this could be a really tricky area in the tax code. So I'd consult your CPA. I'd probably want to get out of those sooner rather than later. If you like gold, find other ways to own them. I probably wouldn't want to do inside that IRA for these purposes.
Right.
So lots of reasons.
Can we get to really big news today? Important news. Today is 110th anniversary of Oreos.
Oh, man.
They are celebrating it with a new Oreo cookie flavor called chocolate confetti cake.
Chocolate confetti cake.
Yeah. So 110 years. It's a Mondelez company. So Oreos. That just makes your whole day better. Doesn't matter how bad things are, eat an Oreo.
When's the last time you had an Oreo?
1911.
Oh, I know better than that. I've seen you eat Oreos. So Lance, if anybody knows, Lance is, he tries to be the beacon of good health, when he's not in, surgery or, getting something fixed, because he is the bionic man as well.
Yes,
and his strive to physical fitness.
Yep.
But, you do have
a
weak spot for Oreos.
Yes, I do. Yes.
Yeah.
You know what my vice is?
What's that?
It's peppermint patties.
Oh, okay.
York peppermint patties is actually my vice.
Wow. See, I would have lost that if we were on Jeopardy or something. I would have said Oreos for sure.
No, trust me. Oreos are actually in order of preference, right? If I had to have it, it'd be my wife's chocolate chip cookies because she makes the best in the world, but she doesn't bake them because she's always got me on a diet. In fact, we're starting a brand new diet today that she discovered online. So she ordered the book, and so guess what? Diet changes today. So she doesn't bake those. So York peppermint patties are second, and Oreos are third. But those are a rare treat. So.
Awesome.
All right, wrap up the show for today. Get by the website, realinvestmentadvice.com. Send us an email. Tell us what your favorite advice is. Keep it clean. And if you have any questions or comments, let us know. Always happy to help you. Our latest blog post is out. The second part of Michael Leibowitz' 2022 Outlook on stocks and bonds is out today on the website, realinvestmentadvice.com. 3 minutes on markets money coming up here shortly. It's all there for you, realinvestmentadvice.com. See you back here tomorrow.